The U.S. subprime crisis of 2008 rocked markets all over the world. Its impact was felt even in India, with a correction of more than 60% in our broader markets in the financial year 2009. More recently, in 2018, the Indian rupee fell by more than 12% against the US dollar. High oil prices, a record high current account deficit, the strong US dollar, and volatility in emerging market currencies all contributed to the depreciation of the rupee. This translated into high volatility and corrections in the Indian equity market. There are numerous risks associated with equities as an asset class. These risks may broadly be classified as either systematic risks which affect the markets as a whole, or unsystematic or idiosyncratic risks which affect only a specific stock or a group of stocks and not the entire market. Market risk is a significant element of total systematic risk. Market risk stems from the tendency of security prices to move together. In a falling market, even fundamentally sound stocks can fall. Political instability, wars, and natural disasters are part of systematic risk. In today's interconnected world, systematic risks affect all stocks, and such risks cannot be mitigated only by portfolio diversification. For example, exchange rate risks arise from fluctuations in the value of the domestic currency in relation to foreign currencies. Such fluctuations usually occur in response to a country's shifting balance of payments. Exchange rate fluctuations directly or indirectly affect the wider economy. A rise in interest rates increases the cost of borrowings, eventually impacting corporate earnings and investor returns. Stocks are also subject to unsystematic or idiosyncratic risks. These affect only specific stocks or group of stocks and not the entire market. Such risks may stem from technology obsolescence, changes in laws and regulations, or business, operational, and financial risks. These include risks of poor corporate governance, management inefficiencies or fraud, litigation, labor unrest, and so on. Investors can hedge against stock volatility on account of systematic risks by staying in the market over the long term. By extending their holding period over the long term, they can spread or diversify the risk over time. By staggering investments via systematic investment plans or SIPs and systematic transfer plans or STPs, they can reduce the effects of market risks and also reduce entry point risk. Disciplined investing across market ups and downs offers the benefits of rupee cost averaging. Apart from this, the longer the holding period, the lower the risk, and the return stands close to its mean or average returns. Spending time in the market is more important than timing the market. For unsystematic risks, which affect only a specific stock or group of stocks, the mitigation strategy involves asset diversification through portfolio allocation. A well-diversified portfolio with a variety of securities from across sectors can help mitigate the overall idiosyncratic risk in the portfolio. Congratulations! You have now reached the end of this module on risks inherent in equity. Take a moment to think about these questions. Why are equities volatile, and how does volatility impact risk? What is the difference between time and portfolio diversification? How can mutual funds aid in managing volatility? For the answers to these questions and to learn more about managing equity volatility, view the other course resources. Scroll down to learn more.